Welcome to the Solution Nation podcast. My name is Sean Snowday, and I'm the president of Solution Nation. Solution Nation is dedicated to providing a platform for investors to learn about Israel's most dynamic public and private companies. We interview lead venture capitalists, Wall Street analysts, investment bankers, and managers of incubators and accelerators. Today's guest is Ronald Weissman with the Angel Capital Association, and the topic is the risks of angel investing. Now, angel investing isn't for the faint of heart, especially when valuations are at nosebleed levels. Before you delve into any specific opportunity, you may wish to take the pulse of the market into account. You may also want to consider such issues as, what is different about Generation Z angel investors, and what are the risks associated with simple agreements from future equity? And why should investors be concerned about possible cramdowns and carve-outs? Please remember that all content provided on the Solution Nation podcast and website is for educational purposes only. Nothing shall be construed as investment advice. Investment decisions shall not be made based on information, written, verbal, or otherwise, posted or spoken on Solution Nation. Conduct your own research or consult with your own investment advisors before making investment decisions. So here's my good friend, the host of the show, and the CEO of Solution Nation, David Wanatik.
Welcome to Solution Nation, everyone. My name is David Wanatik. I'm the CEO of Solution Nation. I'd like to welcome you to today's podcast. Speaking today is Ron Weissman. Ron Weissman will speak about the state of the angel market and metrics to consider to determine if the angel investing market is healthy or overheated. Just a couple of words about our speaker, Ron Weissman. He is the vice chair and a member of the board of directors of the Angel Capital Association. He is also the author of the Angel Capital Association's courses on assessing and managing risks in early stage investing and angel-backed boards of directors. Ron has more than 17 years in global venture capital experience and 16 years in angel investing. He has recently advised investors, governments, corporate venture capital firms, and startups in locations as diverse as Armenia, Germany, Israel, the Republic of Georgia, Italy, Chile, Australia, New Zealand, and across the United States. We could go into a lot more depth on Ron's background. It's a very long, very impressive background, very successful. But to get into the heart of the issue, I'll stop with the introduction and welcome Ron Weissman.
David, thank you very much. It's a pleasure to be here. It's a pleasure to be back in Israel, even if only electronically. And I'm very happy to entertain a real dialogue with what's going on in the largest of the angel markets, and that is in North America. Many of the lessons I'm talking about today are applicable globally, particularly in countries with very strong ties to the U.S. ecosystem, of which Israel would probably be certainly number one or number two. In any case, back in February, I started noticing some strange things going on in private markets and public markets, and began saying, well, I've seen this film before. I think some bad stuff's about to happen, and started giving talks in February. In February, it was kind of, I say it was like a small earthquake tremors. By Q2, it had become, a real earthquake. So let me talk today about what's happening in startup-related markets. So let's first talk about the angel ecosystem. What's happening right now is angels are getting squeezed in multiple directions. First, we have a whole new class of investors and entrepreneurs, Gen Z. They want a really different kind of model of angel behavior, angel investing, much more informal, and they are attempting to reinvent many of the best practices of angel investing with DAOs, crypto collectives, fluid startup hubs, Gen Z social clubs. I'm sure you have seen many of these things. So that's one source of pressure on traditional angel groups to change. VCs have rediscovered seed stage. They had largely abandoned early stage investing in 20 and 21, but they have roared back late 2021 With many of the leading VCs now have 300, 400, 500 million dollar seed funds targeting exactly the same space that angels are in, but with much bigger staffs, but with a, shall we say, a less dedicated focus and a less continuous track record in seed stage. But some of those who have done this, Greylock, Andreessen Horowitz, and so forth, they've also added VC accelerators to the offerings they provide. In the US, we're also under pressure from the Securities and Exchange Commission and Congress that proposed changes to many of the fundamental things that allow angels to be angels. One of which is, for example, we can invest out of our retirement funds. And there are proposals now that to eliminate that. So far, they haven't happened, but that would have a real material effect on US angel activity. Another is raising the wealth threshold for angel investors. It was last set in the 1980s, and Congress and or the SEC are thinking of raising that. In any case, lots going on Capitol Hill. Very little of it helpful to angels. So my group, the Angel Capital Association, is busy trying to educate Congress on the fact that many of these things would reduce the flow of capital to the most important people in our ecosystem, which are entrepreneurs. So the agenda for the rest of this morning is the end of the great bull market, markets in turmoil. What are our best practices now in deal making in the emerging new reality? And there's a coming venture capital reset, happens about once a decade after bad economic times. And where do we angels fit in? Well, a story starts with a happy one. In 2019 to 2021, U.S. exits soared. And whether it's exit counts that was up, was up by 50, 60%, or whether it was the value of exits, exits absolutely dramatically soared, much higher than previous years, the aughts. So when exits soar, what happens? Well, venture capital funds post record returns, and you can see the quarterly IRRs off on the right had also soared to an extraordinary level. Much of the period between 2010 and let's say 2018 was not a terribly profitable one, but suddenly we see IRRs zooming compared to previous years. Limited partners are making lots of money. So great venture returns led limited partners to flood venture capitalists with cash. And you can see the top is what the limited partners received in distributions from venture funds. On the bottom, you can see the flow of limited partner funding back to VCs and how these flows are parallel and of gigantic proportion. But what happens when there's more money chasing a relatively fixed number of excellent deals? You have an investing spree. And so U.S. venture capital startup funding reached a record high in 2021, nearly $650 billion invested globally, and that was 2x the previous year, and half of that funding went into the United States. So more venture cash, more deal competition. Valuations grew dramatically in 7 years. What I want to say is dramatically for the same stage of development, the same quality of companies 5-6 years ago are now, for angel investing, angels last year paid twice as much for the same company that they did in 2015. For mid-stage companies, 4 times as much, and for late-stage companies, 7 times as much. As you can see, the dramatic growth in valuations at every stage. I will say angels were the most sober, but if you're looking at late stage, you're paying 7 times the amount of money you were for the same company, the same class of company. So things, in my opinion, were extremely out of whack. This takes us to the traditional venture capital funding cycle. So we start in the top right with exit nirvana, IPOs, M&A, SPACs, fund returns go wild as these exits are just at historic levels. So limited partners, having gotten great returns, pour billions into new funds. The size of those funds grows enormous, and even third-tier funds with brand new managers get funded. And the venture tourists, the hedge funds, corporate innovation, and anybody with a checkbook pours into venture capital, and there are lots of investment fads. I'm sure many of you will recognize the image at the bottom, the bottom right here, which is one of from the Bored Ape Yacht Club series of NFTs. The latest valuation for this image was $2.9 million for a cartoon of an ape, and that was a 7x value increase from the valuation several months prior. So this is one example of investment fads. So VCs are competing for deals, and of course, valuations soar. There's overfunding, and angel valuations rose too, but not to the same extent. What tends to happen after this is investor indigestion, because we know that the enemy of high returns is high valuation. You can't make as much money if a company is valued at 100 million as if the same company is valued at 50 million. So valuations ultimately decline. You look at any technology sector in the software, you'll find typically 50, 60, 70 companies that look identical. And these Me Too's will eventually die. The top 2 or 3 will survive. And as a result of tighter cash, you'll have recapitalizations and down rounds and other ugly things happening to our portfolios. And finally, a VC reset. As the VC tourists leave, the limited partners and funds reduce their interests. We might even have a Series A or Series B crunch, where after your angel round, it is harder to raise follow-on capital, and when VCs rethink this asset class. The last time this happened was around 2013, 2014, at the tail end of the recovery from the Great Recession. A report was issued by the Kauffman Foundation, a foundation that studies entrepreneurships, of the 97 funds in their own portfolio. And they made some devastating critiques of venture capital as we knew it then. That report led to a broad reframing of venture capital terms. VCs contributed more cash to their funds, and they had a higher bar to cash before they could receive any funds as part of the profit share. And that lasted probably until 2019, where the explosion again of VCs caused the VCs to be in a more powerful position in setting terms. Well, in the middle of the traditional VC cycle, where we had some of the largest inflows and outflows in a very long time, we had what I call the attack of the zombie black swans. I think you all know the story: the worst global epidemic in 100 years, rising interest rates, inflation, the worst financial performance in 50 years, the first major European land war in 75 years, the great decoupling as Europe decouples from Russia and as the US decouples from China, global supply chain. You know the story. Well, this has led to significant downturns in almost every index in the public markets you can imagine, whether it's the S&P 500, NASDAQ's biotech index, the NASDAQ index, the index of IPOs. When stock prices fall, market caps fall. Everything gets repriced. Revenue multiples fall. That's important to us angels because we use revenue multiples as one of the ways of establishing a valuation that we invest against. IPOs have been repriced, delayed, or canceled. I just read this morning that the primary promoter of SPACs has pulled 2 SPACs because they could not find companies to buy. Most of the SPACs issued in the past couple of years today are trending well underwater, below their IPO price. So SPACs have become a kind of non-issue. M&A has been repriced or canceled. Unprofitable unicorns are waiting for an IPO for the next round of funding, have been delayed or canceled, and those are in crisis. Growth stage venture capitalists are triaging their growth stage portfolios, saying who is going to be a winner, who is going to have a hard time. We'll fund the winners and give some help to the others, but we're going to really focus on our winners. Early stage valuations are now beginning to fall. And of course, our investment portfolios shrink in value. Don Butler of Tomvest has noted that between the time public markets are in crisis and the time private markets like ours see the same impacts is usually 1 to 2 quarters. So the first half of 2022, there was a significant M&A slowdown, as you can see, 37% decline in the number and the value of M&A between Q2 of last year and Q2 of this year. The IPO index is down by 54%, and there's been a 95% decline in the number of IPOs this year, and only 12% of firms that IPO'd in 2021 are trading above their IPO price. So the IPO market is essentially shut down. The exit window is mostly closed, as you can see. This has been a really, really bad year for exits on the heels of 2 brilliant years. So VC fundraising is slowing, as you can see on the right-hand side of this chart. A recent study indicated that 2/3 of U.S. venture funds have been marked down in 2022. That is, they've told their limited partners and their investors that the value of the fund is down. New fundraising is going primarily to mega funds, the largest funds with all the brand names, the Andreessen Horowitz of the world. Limited partners, as they did in 2013, 2014, are demanding tougher terms from venture capitalists. Startup funding is beginning to slow, and the message from VCs to portfolio companies is make your capital last longer. VCs are even lowering the size of the fund they're trying to raise, and the newer funds, those without a multi-generation track record, are the hardest hit. At the same time, VCs are sitting on $290 billion in dry powder. It's unclear where that's going to go or when that's going to be unlocked, but VCs right now are very, very cautious. So you can see the decline in startup funding through the first half of this year, and this continues. Q2, early Q3 has continued this trend. If we look at the impact on valuations, one of the key things that we all should be focusing on are valuations. We look at public software multiples. Enterprise multiples for enterprise companies have fallen between 2021 and 2022 from 14 times revenues to 7 times revenues. The Facebook, Apple, Amazon, Netflix, Google, large caps have fallen slightly, 7x to 6x, but they indeed have fallen. Fintech, 15x to 4x. Consumer internet, 7x to 3x. Overall, the typical software multiple for public companies has been cut by more than 50%. And this data comes in part from one of the world's leading startup investors, the Cap IQ's data analyzed by Andreessen Horowitz. So capital markets are in turmoil. The tremors we felt became earthquakes in Q2. Late stage has been the hardest hit, particularly amongst the unicorn classes and the mezzanine firms ready to IPO. We've got what's called the denominator effect. And the denominator effect, it works something like this. When the value of your public holdings goes down, and you look at the percentage invested in each asset class, it looks like venture capital is suddenly gone from 8 to 12% of your portfolio to a much higher number. Nothing has changed. except the valuation of various asset classes, but you now appear to be overinvested in high-risk asset classes, the illiquid classes. And this causes fund managers and fund of funds to reallocate away from venture capital. So we see startups reducing the size of their ask. We see Y Combinator, the world's most hyped incubator accelerator, shrink its fall 22 batch of startups by 40% because, quote, market conditions do not permit us to invest as we had in the past. The top investors, Andreessen Horowitz, Sequoia, Tiger, Elevate, Insight, have all now over multiple quarters ceased being the most active investors and have pulled back. As my colleague and friend Sven Weber, who's the managing principal of Knightsbridge, he said in the secondary markets, strong companies are trading at 90 to 100% of their former value. Weaker companies are trading at 50% of former value. This is the kind of natural triage I've mentioned before. But for us active, experienced venture and angel investors, this is not all bad news. And we'll talk about that shortly. So Q2 by the numbers, IPO and M&A exits down. Life sciences, only 8 of 121 IPOs are trading above their price. There's been a 57% decline in the biopharma index. 402,021 IPOs across all sectors. 12% are trading above their IPO price. And it's estimated that for M&A, there'll be a full year decline of 56%. 27% decline in VC dollars, 46% decline in biopharma deals, and a 43% decline in the amount of money going into biopharma. In terms of public markets, there's been a 50% or greater decline in almost everything, software, biotech, you name it. And 66% of US venture funds had to tell their limited partners that those funds have been marked down and fund sizes are being reduced for second tier. Just to give you the latest update, you can see the median software as a service ARR multiples from May of 2008 to the beginning of August this year. And you can physically see the bubble that was created 2019, 2020, and how those valuations are now back to where they were in the mid-teens, what I consider the recent normal. So what's the road ahead? How are we doing deals? How do we help our portfolio companies in this new reality? Well, mid Q3, we're seeing the same thing we saw before. NASDAQ is down by almost 28%. The S&P is down by 20%. U.S. gross domestic product is down by nearly a point. And interest rates continue to rise in the U.S. and Europe. Seed stage dollars, though, are doing pretty well. Again, the people like angels, valuations are trending a little bit up. Deal terms are getting a lot better for investors. More investor protections, firmer liquidation preferences. The market is shifting, the balance of power from hot entrepreneurs to, shall we say, sober investors. Series A, B, and C are well down. According to historic norms, they're up against 2020, but the overall trend is going down. Early stage, 50% down year over year. Late stage, 60% down. And remember, we haven't seen the worst yet because public markets still lack, private markets lack by 1 to 2 quarters. A recent study was done by the Software Equity Group, who had lots of free publications on the state of software and software valuations. I would encourage you all to check out their website. Did a study of investor sentiment. What's the second half of the year look like? 5% of investors believe software valuations will increase. 50% believe they will decrease further. We have not yet released the study, but we just completed a study from the Angel Capital Association's membership, and a significant percentage, majority of angel investors believe that angel valuations will decline in the second half of this year. The Great Recession, it took 4 years for Series A, B, and C valuations to recover. 4 years. So don't expect necessarily a quick turnaround. I'm pleased to say that CEOs are reacting with great maturity to the current crisis. In fact, there's some great jokes floating around. Look, a new email from our VC. Are they going to participate in our next round? No, it's another email about the 20 steps to survive a recession. This means that both VCs as well as entrepreneurs are getting the message that things need to change. So where are we today in the venture capital, private capital cycle? I believe we're here. We're rethinking valuations. We are triaging our companies, and many of them will not make it. Even unicorns are being triaged. So we're seeing increasing number of recaps and down rounds. I think in the month of July, amongst large cap companies, there were private, there were something like 80 down rounds. So beware of predatory capital, because VCs like to take advantage of startups during these kinds of situations we're in. And I expect, as I saw in 2000 and 2001, as I saw in 2009 and 2010, recaps, down rounds, the need for carve-outs, that is to specify that regardless of where your stock options stand today, that we will reserve a percentage of the exit proceeds for management to incent them to move forward to get to an exit. We'll see cramdowns and pay-to-plays. We will see higher liquidation preference stacks, significant dilution to existing investors and existing management, and we'll also see some insider self-dealing as VCs who control boards may want a company that they've invested in to be essentially given at a low cost to one of their better performing portfolio companies. And again, the 2009, 2010 was filled with this kind of behavior. So how do we protect ourselves? Well, first of all, before we go to VCs for capital, let's syndicate amongst angel groups. One of the most important things that my group, the Angel Capital Association, does is promote syndication. Don't ask for the larger ask you may have asked for last year. Think about smaller asks that are easier to digest. Venture debt is becoming very, very popular. Blackstone alone is committing $2 billion to a venture debt fund. Companies are offering extension rounds for whatever happened in the past couple of years, not changing the terms, not asking for increases in valuation, but extension rounds, sometimes sweetening the deal with warrants. Many companies are tapping VC reserves. As I mentioned, there's a lot of VC reserves, but most of those reserves are pre-allocated for certain portfolio companies. So be aware that VCs are already asking themselves, which of our portfolio will we support and which won't we? They're already tapping into those reserves and spending, and by the time you need capital, it may not be available. So work with your investors to see if you can reserve some of the capital that's not been spent. One of the things that startups are going to have to do, those who were most vulnerable were people who raised rounds in 2020 or 2021 at ridiculous valuations, but who now need capital because they're perceived as overvalued. And either they take a crushing down round or they need to show investors how they're going to quickly grow into their last round valuation. And please don't reduce that because I'm almost there. Some VCs are panicking and telling CEOs, sell now if you can, even at a discount, while Cisco and Microsoft and the other FANGs are still buying. And for me, one of the most important things is governance, because an experienced board is critical in handling all of the challenges of recaps and down rounds and pay-to-plays next round financing, potential M&A. These are things that require people on the board who have been there, who've seen these before, and know how to work and negotiate in tough times. So your first line of defense is an experienced board of directors. Advice to investors and to management, as my good friend, unfortunately, who died this year, John Houston, the founder of the Ohio Tech Angels Fund, would you rather raise cash at my valuation or raise nothing at your valuation? So work with your CEOs to make them understand that the world has changed. For us, the opportunity now is to find and fund startups with unique, high differentiated value. And most of the early stage investors I know are planning on investing more, not investing less. It's becoming an equity buyer's market, focusing on things like fact-based valuations. My number 2 piece of advice is burn the 2021 deal playbook. 2021, in terms of how we did deals, isn't the guide to 2022. For me, the classic 2021 deal was a safe deal where there is no governance rights, a high valuation, and almost no diligence. That is not a guide ever to successful investing, but that's the way many deals were done in 2021. My favorite comment from a CEO recently was, I promised my last round investors a 2x step up. I'm not going to accept a flat round. My attitude is, I don't care what you promised your last round investors. That's irrelevant. The question is, how are you performing today and how do markets value you today? Yes, there will be down rounds. And when I negotiate with CEOs, I try to tell them that a high valuation is a double-edged sword. On the one hand, you feel great, you've taken less dilution, your team will feel proud of you. At the same time, when the market shifts and goes down, you are definitely a candidate for a down round. So I said, we tried to warn you, but you wouldn't listen. As I've said, and I'll say probably again today, our best defense is a real board of directors, not 3 guys the CEO went to college with, but a real board with real experience. So one of the questions I ask is, who is running the show today? If you look at millennials and you look at Gen Z, fully half of millennials came of age in years where they've never seen anything but an up market, and all of Gen Z turned 21 during the great bull market. So the longest bull market in history. So we have a whole class of investors, managers, CEOs who have never seen a down market, which means they have not had the experience in managing board conflict, limited runway, down rounds, layoffs, predatory investors, dilutive financing, equity restructuring, employees who are now saying, screw stock options, I want cash, repricing of options because options are underwater and nobody is motivated to stick around if my $15 a share options are now worth $3. They've not dealt with unhappy teams or customers frustrated because we had to cut back on customer support or PR disasters or shutdowns. So again, you want some mature investors on corporate boards because they have seen these things before. This is not a dig at Gen Z or millennials at all. It's just a fact that if you haven't experienced these things, you are less likely to have a store of best practices or a network able to deal with them. So I'm predicting a coming venture capital reset. I've already talked about triage, which is happening now in venture portfolio after venture portfolio. I participated in one last week. Who sets the tone? And the fact that some people are incredibly innovative does not mean that they're wise in terms of how capital works. What does it take to build value? VCs are now saying, forget get big fast. Now you need to get to profitability fast. I expect to see the exit of the quick buck venture tourists, the hedge funds and so forth. They always flee the market when things go south. I believe corporations are now rethinking the way they do corporate venture and innovation. and how, again, they apply some triaging principles to their own portfolios. We're all beginning to rethink valuation methodology and portfolio strategy. One of the major turns I'm seeing, what is being funded, is that science matters, fundamentals matter. As David says here, finding solutions to very serious problems is what matters. And of course, building exits that are not just a flash in the pan the day of the IPO, but still create value months or years after the IPO. As I've said, today's IPOs are largely disasters in the past 2 years because they're trading well underwater. So my favorite headline, recent headline: venture capitalists say the era of recklessly burning cash is over. And that means that fads like blitzscaling, get big fast at any cost, are going to become minority positions. The VC calibration is beginning. As one very interesting article in The Information said, venture capital isn't the problem, it's venture capitalists who are doing the wrong kinds of deals. New York Times, the boy bosses of Silicon Valley are on their way out. And the folks behind the new model, the safe model of investing, Y Combinator, are now being blamed in part for the startup correction we're in by promoting high valuations and no governance. So I think the low value, small VC model is going to be under some stress because the people who are going to be prized right now are people who can add portfolio value and really help their portfolios. We're just going to see the end of the fast, high valuation, no governance deal. We need to organize portfolio management, and that's what the big VCs like Sequoia and Andreessen Horowitz are doing, building out very impressive portfolio support teams. Angels, too, are reorganizing to add portfolio value and serious portfolio reviews, seeing how can we help our companies, whether it's fundraising, customer introductions, or exit introductions. Angel groups are becoming way more sophisticated in how we help our portfolio companies. The large funds want flexibility where they don't have to focus on the 10-year life cycle of a fund. They're becoming investment advisors, which allows them to extend the runway of their investments and to invest in public and private companies and hold companies that have recently IPO'd longer than they could as VCs. We're seeing rotation as some of the larger funds are moving out of late stage into early stage, really rethinking how we value companies. And a really interesting report out of the University of Chicago this year said that 50% of venture bets have been predictably bad because they're focusing on the wrong things. They're not focusing on metrics. They're using things like, is this a repeat entrepreneur, a serial entrepreneur or not? Where, according to their work, serial entrepreneurs don't necessarily have an advantage over first-time entrepreneurs, but they're saying we're doing diligence wrong. So I don't agree with all their findings, but I do agree with a lot of the diligence done in the past couple of years has been fast and sloppy. In all of this, we as angel investors have been far more resilient than any other sector. We've remained the backbone of the startup ecosystem in good times and in bad. We stayed the course during COVID. VC seed stage funding fell dramatically in 2020. What did we do during COVID? The most disruptive year, the number of deals per angel group grew 27% compared to pre-COVID. So we supported our portfolio companies. We also invested in new deals. So we're staying the course. So in my view, it's a great time to be an angel. We're transitioning from a seller's market to a buyer's market. Deal terms are becoming more rational. Strong companies know how to build market share in down times. So when we do our triage, those stronger companies are likely to be gobbling up smaller, weaker ones and gaining market share, technology, and teams. Remember that global leaders were built in down markets, and it takes a long time to exit. So as my boss and friend Steve Jobs used to say, it takes a long time to build an overnight success. The chart on the right shows what happened during the first year of COVID with angels in the US. They increased both the number of initial deals and the number of follow-on deals. So we didn't flee the market, we stayed the market. We remained consistent, and even in 2022, the percentage of capital that the angels represent is actually increasing as venture slows down. Finally, focus, as I've said, is great companies are built during downturns. But to do that, companies need our help. So we need to provide high value add. And that's what the Angel Capital Association prides itself on in terms of our members: mobilizing business ecosystems, access to global networks, adding global reach and financial depth, adding governance and mentoring, and using our own personal private networks to help facilitate exits. So great time to be an investor. Valuations are down. Everything else costs less too, whether it's rents or you can get computing equipment pretty cheaply, and of course using the cloud really unlocks tremendous value. Massive talent pool during the Great Resignation is unlocked, looking for new things to do. Deal terms are better. Capital is no longer a commodity. When we can add value, we've really distinguished ourselves. And less capital means fewer of those Me Too companies. So now is the time to show the value of strategic angel capital. Get organized, learn how to add value, and you will do very, very well. My advice to my friends is put your foot on the gas. I know I'm investing more this year in early stage. So finally, let's not make this our meme of the year. I'm sure you've all seen this. Disaster Girl, a photo that was sold as an NFT last year for $500,000. Let's not make this our key theme. And finally, the Angel Capital Association, my group, has both U.S. as well as international members. We provide news and data about our ecosystem. We provide education on everything from term sheets evaluation to boards. And we are leading the fight on Capitol Hill to protect terms for U.S. angels. And I would check us out. And if we can be of help to you, please look us up. Our annual conference is in middle of May in Las Vegas next year. And again, it's a great place to network, to syndicate, and to learn best practices. So thank you very much, David. Thank you for the chance to talk to this group.
Well, thank you very much, Ron. That was an excellent presentation, very informative. I'm sure that everybody that listens to this will learn a lot. If you have a few minutes, perhaps I can ask you a few questions.
Sure, absolutely.
So just along with one of your recent comments about being cautious about making Me Too investments in Me Too companies, are there any metrics we should look at, such as the size of the addressable market to the amount of capital raised to direct towards that addressable market? So, if the addressable market is $2 billion, you should be concerned if $40 billion is being raised to pursue that market.
Right. Absolutely. I mean, if you're so let's look at some math. If you are in a market with 50 startups, you have a 6% chance, all things being equal, of being 1, 2, or 3. And as we know from experience, the top 3 or 4 companies in a sector usually get all the exit proceeds. Everybody else gets dribs and drabs. So the first company to exit may get as much as 40 or 50% of all of the exit dollars. The next might get 20 or 15 or so. So you want to be funding a company that doesn't just have an interesting idea, but has the management team, the network, the backing to become one of the sector leaders. So one thing to look at is market share. Does somebody have kind of like undethronable market share? It's just so dominant that the winners have already been called and the major buyers have already gravitated there? Or is the market still open? Has there been no winner really called yet? Make sure the technology is top flight. Make sure the team is capable of having a world domination strategy, because that's what follow-on investors look for. And so I can't give you hard and fast rules. Those are some of the things to think about. Okay, great. And then you mentioned safes, some concerns with safes.
what are some of the concerns investors should have with investing in safes?
Thank you for that question. There's several concerns. The first is that safes are essentially a one-page promissory note that may or may not even be on the balance sheet. It's unclear how those are treated. You may not get qualified small business stock exemption in the U.S. if you hold a security for 5 years and you were an investor when the company was worth less than $50 million. Federal taxes, you pay nothing when the company exits. It's unclear. The safe note has to be written in a certain way so that you get with that kind of treatment. Most important for me is that safes often explicitly say that the investors in this note have no rights, no governance rights, no nothing, except with a side letter, a pro rata follow-on rights. But you have no role in the company. You can't appoint board members. You have no observation rights. You have nothing. And this is a time when companies need mature, wise counsel. So counseling CEOs and showing them that you really don't need, investors on your board, I think is about the stupidest thing that could happen right now. You need our help, and we want to give you our help. We can't do that from the bleachers.
And the preceding question should have been, what does SAFE stand for?
A simple agreement for future equity.
Okay, great. Thank you. And then you spoke about predatory capital. A couple of bullet points I took from that. Maybe explain what a cramdown is.
Okay. A cramdown is also referred to as a mutual assured destruction clause in a term sheet. It basically says, that if any investor who does not invest in this current round gets crammed down, and that cram down can be anywhere from 10 to 1 to 1,000 to 1. If you owned 1,000 shares before, you might own 1 share or 100 shares now. So it's a extreme form of dilution that the goal is to force investors to participate in the ongoing round. Also a pay to play, but the cram down is what happens at the end of a bad financing round to investors who did not participate. Okay,
great.
Their share is literally crammed down.
Okay, all right. And then what do you mean by carve-outs?
So you're in a situation where the value of your stock options is pretty low. And I'm the CEO, and my stock options, let's say, we're at $15 a share, and the value of the stock right now, based on any valuation metric, is $3 or $4 a share. As the CEO, I make no money if the company exits. So what the board typically does, and this requires a vote of shareholders, but what it typically does is say, we're going to carve out in the range of 8 to 12% of the exit proceeds in a bucket, and we'll award those based on some formula to the existing team, primarily the executive officers, but sometimes the entire company. And it could be based on length of service. It could be based on the ratio of how many shares you have to the total, employee pool. But there's a way of handing that out at a successful exit. Carve-outs can start at the first dollar, or they can start at the first dollar after the investors get their capital back, not profit, but get their capital back. And in down markets, it's something that is often and fiercely negotiated, because you want management on board. The investors can't do an exit by themselves. You have to motivate.
Great, thank you. That's very helpful. When you first mentioned carve-outs, I was thinking that maybe, this is in the context of predatory capital, I was thinking that maybe we were talking about a VC carving out a hidden asset the company has, like the patents. So if the company goes bankrupt or what have you, that the VC would own the key assets like patents or distribution rights or something like that.
What typically that can happen, but typically, and so let me give you the kind of following scenario. let's say that you've got for a senior line of debt, a venture debt round on top of what you have. Well, that person, that institution is senior and gets money back first. And let's say that term sheet has some strange provisions. Let's say that, for example, when you start missing your quarterly numbers, they get more warrants, and they look like they're about to own the company. Well, the typical VC response to that is, okay, here's the company, you manage it. If the rest of us are locked out, including management, then you go ahead and rescue it. Or if it's the VCs are in that position, they can't run the company either. So typically what happens is, at least in the US, is an assignment for benefit of creditors. Remember that in a liquidation, the creditors stand above the shareholders, and typically most companies have debtors. Have creditors, and therefore you need to find money to pay off the creditors. So the assets of the company will be turned over to a third party on behalf of the board that will sell those assets, including the IP, to first pay off the debts of the company. It's the rare company that doesn't have some kind of debt.
Okay. All right. And then when you mentioned insider self-dealing by VCs, that mean VCs selling one company to another? Yep. In their portfolio? Okay.
Yeah, I resigned from the board of directors when that attempted to occur. The company was doing okay. It wasn't in a terrible position, but the board was controlled by one investor, which was a private equity investor, and they had their hearts set on selling this company to another one of their portfolio companies at dirt cheap prices, in order to bulk up that company and make them stronger. Well, the investors, management, and the team would have been screwed by that deal. It was a financial manipulation. It wasn't necessarily illegal, but it certainly was, from my opinion, quite unethical. And VCs do it. So I was left with no position but to resign from the board because I would not approve that. It was called insider dealing.
Okay. So I know this is a later stage question, but are you seeing any kind of crazy terms that are offered to later stage investors to be able to report very high valuations, or to be able to call a company a unicorn, such as if you invest in this very late stage round, when we have an exit, you get 3 times your money back first, or something like that?
Yeah, right. That was very, very popular in the past 4 or 5 years. And many unicorns were unicorns in name only, because if you look at the distribution of cash at a non-IPO exit, remember during an IPO, all of our shares convert to common. There are no preferences, but for an M&A sale, it was 2 times, 3 times, 4 times liquidation preference in the last round. Was not at all atypical. And it's not unethical. It's not even immoral. It's what some people do. But if you look at the cash proceeds, the company really wasn't worth $1 billion to all of its investors. It was maybe worth 300 million to its latest investors, and a lot less to those lower on the stack.
Mm-hmm. Okay. Are there any segments?
I'm not seeing those now, but again, I don't track late stage deal terms as well as I do early stage.
Okay. Are there any segments of the early stage market that are generating more capital infusion, that are ascending in valuation?
The number one is security. Anything in the security space is getting strong valuations, in part because of the very uncertain times we live in and the increasing threats. Whether it's hackers from Eastern Europe, whether it's insiders dissatisfied, the threat profile is continues to rise. So I'd say security is probably one of the top spaces. Second, it would be logistics. Given the supply chain crisis we're in, anybody who can do global logistics is getting fair valuation. I would have liked to have said fintech, but fintech has been probably the strangest performing sector. In 2020, I believe one of every $5 went to fintech companies. And fintech this year has been in free fall, in part because there were so many fintech companies, lots of Me Too's there, in part because people think that until the global economy stabilizes, there's not going to be a lot of room for new innovation, parts of the big fintech buyers, things of that sort.
Okay, so maybe the last question, we can just talk about the pros and cons of angel groups. Seems like one of the benefits, of course, there's money to be raised by speaking to them, by presenting to them. You also sort of get a nice consultation. Even if you don't receive capital from an angel group, just the process. I'm a member of 2 angel groups, and they're very, very thorough in the way they scrutinize. And there's committees that get together, and experts are in the audience that know a lot about that given industry. So that's a benefit. But maybe a downside is the lag. So by the time you have an interest in speaking to an investor group, an angel group, with an application, there's committee reviews and scheduling, and it might be 6 months later that you actually present. So anyway, maybe you can expand on those issues.
I think you just said it all. On the one hand, you're the part of a group. We can bring way more capital to bear. We have broad networks. We can help you in many, many, many ways, but it's not appreciably faster than a venture round. Although some groups, like Tech Host Angels, have studied the problem and said, how do we get to a decision after meeting you in 1 month? So there are some groups that are really trying to accelerate that process. But in today's market, everybody is slowing down. Mm-hmm. There's some other issues. One is that if you have more than a certain number of members, I think it's either 199 or 299 investors on your cap table, you are de facto a public company in some markets. So you don't want to confuse your cap table with too many individual investors who will need to assent to anything that investors need to assent to, like change in capital structure, like new money, like carve-outs. So it becomes just a real nightmare if you have to manage 100 separate contacts with 100 separate investors.
But if the members of the angel group that want to participate in a fundraising opportunity, if they form a special purpose vehicle, are the individuals in that vehicle counted individually? Is the vehicle counted as one investor?
No, it counts as one investor.
Okay,
that's why people do it. It's also easier for the company. There's one neck to choke, is not 100. And there's usually a class manager who manages everything on behalf of fellow members.
Mm-hmm. I suppose a company appealing to angel groups could offer a better inducement, offer some inducement for a fast decision, right? It could offer a discount on the valuation if decision is made within 2 months or something like that. But there's a lot of negotiation, but.
It's not massively popular, but I have seen a fair number of situations where the company will offer warrants and will offer a lot of warrants for closing in a month, fewer warrants for closing in 2 months, less for 3 months and 0 after that, as a way of inducing. And my attitude is I'm in no rush. I like to see more facts. I'd like to see more revenue numbers and how well you're doing. And I'm willing to pay for that by not getting these special these special benefits.
Okay. Well, this was very, very informative. And again, I'm sure everybody that listens to this will learn something. Great presentation. Great job answering my questions. So we don't want to take any more of your valuable time. You've been very gracious in speaking to us today. So Ron Weissman, thank you very much for an excellent podcast.
Thank you very much, David. Good luck.